Let's get this story up and running. Bring it back home. The community of Nigerian economists, financial analysts, business executives, and others are still swarming over the 2025 budget of nearly 50 trillion naira that President Bola Tinubu presented to the National Assembly last week and has passed a second reading on Thursday. So let's take the New Year's budget to the investment market with my guests. Justin Chukwu, a licensed investment professional and the group CEO at Carry Asset Management. Great to have you connected into the show this evening. We appreciate it.
Thank you, Bosse, for having me. Good evening and happy Merry Christmas in advance.
Is it by design or whatever that we're always having this conversation towards the end of the year when the stock market is red hot? We were here last year around this time, and the song was Catch Me If You Can. Remember, there's no stopping us. So now you're smiling all over because there's so much deal in the market. But let's talk about the tea leaves of the budget first. Then we'll come to the market. What's in that budget for you?
What's in the budget for me is a very aggressive budget. It's an expansionary budget. It's a budget that has made provision about 13.08 trillion naira as deficit. The government has projected to generating revenues of about 34.82 trillion naira, and at the same time spend about 47.9 trillion naira. So clearly it's an expansionary budget. Expansionary budget means the government wants to stimulate economic activities. That's what it then means. But then on the converse, an expansionary budget will also mean that you're going to see a liquidity injection into the economy that could lead to further uptick in inflation. Of course, government expansionary budget always comes with inflationary pressure. So what should we expect? We should expect a lot more investment in infrastructure, assuming we're getting value for money. We should expect a lot more investment in securities based on the amount budgeted for security, which ordinarily should indicate that we should have a better security situation in the country in 2025. But like I said, on the converse, we should also expect the liquidity injection into the economy. If it's coming from ways and means funding through the central bank, it will have a material impact on level of liquidity and therefore further affect inflation rate and as well as affect exchange rate. But if it is funded from the private sector by way of government issuance of debt instruments, then the implication that the private sector will find difficult to borrow because the government will crowd out the private sector by borrowing at higher cost. And that will mean that this economic growth rate from the private sector angle would be weaker, while the government should ordinarily propel economic growth in 2025. These are what we say, assuming all things are equal.
Yes, so well summarized, Mr. Chukwu, for me, that giving me a curtain raiser. But you're an investment securities market professional, an investment banker. Give me what's in the budget from an investment market professional point of view.
Well, Boston, if you look at that market, that budget, you have to look at the basic assumptions and look at how do they affect the investment assets. I had mentioned earlier that if we have a lot of liquidity injection into the economy, we will have an uptick in inflation. But also what goes with that is that in terms of cost of funding, we should expect, if government comes to borrow to fund that deficit from the private sector, you are going to see a sustained high interest rate environment. A high interest rate environment will ordinarily imply that investors will underweight their portfolios in equities and overweight them in fixed income instruments. But we have not seen that in the outgoing year. So if the trend we are seeing in the outgoing year subsists, then we're going to see appreciations in both fixed income instruments and variable income assets, like we have seen, where capital market has gained year to date over 30%. And at the same time, we're seeing interest rates in the region of 30%. We see commercial papers like the Dangote sugar that came to the market that effectively at 30%. We have seen banks going from the money market at above 30%. So we have seen what ordinarily did not happen in the economy. So if the current trend subsists, based on the fact that the government will come to borrow about 13.08 trillion, then ordinarily we should expect interest rate to remain high. If interest rate remains high, I have said earlier, investors will ordinarily switch to a fixed income. But we are seeing a situation where investors are playing actively in the equity space because equities are giving good yield, while as we're also seeing a high return on fixed income instruments. So for the investment market, they should expect one, yield on fixed income instruments will remain high. So what they should do is to stay in the short end of the market. You don't go long when you expect rates to go up. And for those who are borrowing, it's time for them to go long and borrow longer tenor funds now if you think interest rates will remain high.
Okay, so are there alternatives to funding the budget? Can we find money somehow without necessarily borrowing that can stimulate the marketplace, your market? We've talked about privatization. We talked about it for the 8 years of President Buhari's administration on this show, on this channel, and all of that. And it doesn't look like someone is listening that we can find money without really that will stimulate investment, that will deepen the market locally rather than borrowing from outside, unnecessarily issuing more government papers at a higher yield. Look at commercial papers, 20 years, 30% right now as we speak, with MTN, Dangote Cement, others in the market.
Boston, I had actually said this repeatedly at different fora, that today the Nigerian fiscal condition is such that the federal government cannot effectively fund capital projects, fund economic development from budgetary allocations. So what should be the way to go, which is your question? And I had emphasized that for a country in our situation, the best approach the government should do is to go into public-private partnership arrangements, whether they build, operate, and transfer BOT, build, operate, or own BOO, or any of those models or PPP schemes where the private sector can bring in its capital. Like what we have in the telecommunication sector is the build, operate, and own, where the private sector build the telecommunication infrastructure, own it, operating it, and own it. But there are some critical infrastructure that you may not want the private sector to own indefinitely, like the railroads. You can actually have a concession of the major rail corridors for private sector to build them, operate them, and transfer the BOT. The same thing with highways, the seaports, the airports. If we actually farm out these things to the private sector, we are going to get the capital, the funding that we need, which we are currently putting on the balance sheet of the federal government at a high cost.
Yes.
And the private sector in their balance sheet at a much lower. Remember, the private sector has more efficiency in terms of resource deployment.
Yes. So
we're going to get these resources without carrying the burden of liabilities that federal government is currently carrying.
Yeah, so we take it off. So we take all of this off the balance sheet, of the books of the government. Brazil, as we speak, the president just invited about a number of rail companies internationally to come into the country and open up between 4 to 8 major rail corridors that will unlock export, movement of goods within Brazil, the biggest economy in South America. Do you think that's what we should do? Would you like to see something like that happen? How quickly should we do that in Nigeria without necessarily going down this path every year of just borrowing and borrowing just to fund infrastructure and fund expenditure?
Boston, like I said, I've cried myself hawks on this. I've spoken about this more than 10 years running, and I will not cease talking about it on the federal government sees the wisdom in it. I'm happy that you have brought what Brazil has, and Brazil is a far more developed economy than Nigeria. And the government, the federal government in Brazil, the Brazilian government has far more economic resources than Nigeria. And so if they can do it, why can't we do it? Today, we have a proof of concept. Cast your mind back prior to 2000, the federal government owned the telecommunication infrastructure. It was a monopoly until that monopoly was broken. But even when it was broken, it was still at Nitel. And it was said that Nigeria had about 450,000 active lines. Today, how many lines we have? We have more than 150 million lines in the country. The government did not spend a dime to build that infrastructure. At every nook and cranny of this country, you can actually get telecommunication service. Private sector built it. So what stops from private sector from building the standard gauge rails? What stops from private sector from building the key highways, the commercially viable highways. When the government it took the federal government of Nigeria more than 10 years to complete the second Niger bridge.
Maybe the cargo airports, maybe some cargo airports as well for agro allies.
Yes. Now we're talking of a second runway in Abuja airport. We've not built it. We've been coming up in the budget for the 8 years of Buhari's government. It was not built. We're now almost 2 years into President Tinubu's government. It has not been built. It was in concession to the private sector investor. By now, we should have a second runway in Abuja. So the reality is that we do not have the financial resources to continue to invest in infrastructure from budgetary allocation.
So the government can no longer be the godfather of infrastructure. We need to open up concessions. Tanzania is doing the same thing without going to Brazil. And they're making a big splash all over the world on their books. They're concessioning ports, they're concessioning a lot of things, and getting folks like the Adani Group in India to come in and do 30, 35-year deal. But let's get back to this. The budget, does this speak with what the market would like to see in the new year? Would the budget make a difference to the investors? Did it make any difference this year, despite the fact that you folks made a lot of money this year, trillions of naira in market value? You are one of them.
Well, boss, now you my accountant. How do you know?
If you're smiling this broadly on December 23rd, 2 days to Christmas, then I've got to believe that you must have made money this year. 35% market, even for inflation. Look at the news. It's all spread all over here. There's so much deals in the market. And I'm trying to wonder, how did the market perform this year despite the overhang of the policies of last year and still able to make at least 35, 36% gain?
Yeah, that's why I say that the market actually defied the logic that when fixed income instruments are trading at high yield, that investors are overweight their portfolios in equity and overweight them in fixed income.
But that didn't happen.
We have an interesting economy, and I have tried to analyze it. I think there is strong shared economy in the country today. And that shared economy is inflation, asset prices, and asset values, and for creating unconventional market environment as we speak. But back to your question, what are the expectations of the market from the budget? I think the market, like I said, should expect a lot of liquidity to the economy, should expect either the federal government funds it from borrowing. If it borrows externally to fund it, then we should have stability in exchange rates. And of course, the stability in exchange rate will mean that inflation will move southwards. And that will have a positive impact on disposable income, which will mean demand will improve. And demand improve, production will improve. And that will lead to improvement in earnings of even quoted companies. But beyond that, couple of things that are of concern to the market operators and any economists in this country today. And that's the assumption that underlie the budget. The assumptions seem to be overly optimistic. In your earlier comments, you said that for crude oil is about $70.
Yes, exchange rate, inflation projected at 15%. There was not so much talk about interest rate, by the way. So
I'm really talking about global projection for crude.
Yes. Yes. The projection is about 70-50 from Economic. Yes.
So, but the budget is predicated on $75 per barrel.
Exactly.
Budget is predicated on 2,006,000 barrels a day. Currently, the third quarter of this year, we produced only 1.47 million barrels. Second quarter was 1.41 million barrels. If you cast your mind back to the past couple of years, we've not done up to 1.6 million barrels. How are we going to increase crude production by almost 600,000 barrels a day consistently for a period of 365 days? I think that's quite ambitious. So if these two parameters are not achieved, which is why the government had projected about 19.6 trillion naira as revenue from oil. If it's not achieved, then the 34.82 trillion naira budgeted revenue will not be achieved. If that's not achieved, and the government still goes ahead to spend 47.9 trillion naira, then the budget deficit will increase materially above 13.08 trillion naira. And bear in mind, that government is going to spend about 15.8 trillion naira to service debt this year. So that means debt service will further increase beyond that and further create government capacity to invest in infrastructure.
Okay, so so we're talking about the line items, and we go back to very quickly to exchange rate, inflation, and interest rate. What will those mean for the market next year? Is inflation 15%? Some folks says that's a bit too optimistic, Mr. President. Perhaps 20, perhaps 25, around that level, but definitely not 15. What do you think? What will it mean for the market, for my investment portfolio?
Yeah, I think a 15% inflation rate is ambitious. We are dealing with about 34.6% inflation rate in the month of November. But beyond that, bear in mind that we are talking about a very expansionary budget, so which I said will inject liquidity into the economy. Beyond that, also, the factors that are driving inflation have not really been addressed. There are two major factors propelling inflation in the country today. One is the food production, which has to do with insecurity in the major food base of the country. Well, that's why we had an inflation figure at 39.93% in November, food inflation figure. And we have also not addressed the issue of crude production. Yes, the government has an ambition to produce 2.06 million barrels a day, but the reality is that that may not be achieved. So if we do not materially improve food production to bring down food inflation, and as well as improve crude production to stabilize the exchange rate and possibly achieve an appreciation in the local currency, expectation that inflation would drop to 15% next year is quite ambitious.
Very, very quite ambitious. There's quite a whole lot to discuss with you, Mr. Johnson. Chukwu, I was just trying to ask, the market's able to do very well this year. So in terms of what the next year will look like, give me that in 30 seconds.
Well, I think next year we should expect equity market to remain strong. Liquidity further will be injected into the economy. We should also expect interest rates to remain high. So fixed income instrument will remain attractive in the economy.
Oh, great. All right, thank you so much for your time and insightful contributions. As always, do have a great Monday evening. Thank you so much.